Mike Mish Shedlock. Mike's an investment advisor representative for Sitka Pacific Capital Management, and like us, he's also an advocate of Austrian economic theory. But unlike us, he tends to think that our economic outlook is deflationary, whereas your show hosts here have taken the point of view that our long-term outlook is inflationary. So who's right? Well, that's why we've got him here on the program. Mike, thanks for joining us.
Oh, it's a pleasure to be on the show. First off, it's important to point out a couple of things. My intermediate out term is that the U.S. goes in and out of deflation over a period of years, much like Japan did. Certainly, in a long-term time frame, there's going to be inflation. Fiat currencies always go to zero. And it's also important to note that when I talk about inflation and deflation, it's actually, when anyone talks about them, not just me, it's important to have a definition as to what they mean. So let me throw mine out. I think inflation is an increase in money supply and credit, and I also believe that credit needs to be marked to market. And I think deflation is the opposite, a contraction in money supply and credit with credit marked to market. And certainly over the last year, we've not seen credit expand. However, the Fed has managed to stimulate the stock market, stimulate financial assets. The credit on the books of banks has expanded. So by my definition, I believe we've been in a period of inflation since March 2009, actually. I think that at some point the Fed's going to fail in their efforts. People are going to again see this credit for what it is, and $40 trillion worth of credit out there that's not going to be paid back. I think the financial assets, housing is going to continue to fall. I think the financial asset prices are going to continue to fall. I think credit has been contracting, and I think once again it will continue to do that. So it's important to put these, Mish, believes in deflation. Well, my views are quite a lot different, say, from someone like Prechter. I'm a big fan of gold. I've been recommending people buy gold. I've been one of the few deflationists that actually likes gold. So it's a little bit different. I just want to make sure that we point these differences out.
And Mish, our listeners don't often hear the term mark-to-market. It's not a term we normally use here on the show. Just give us a quick definition of that.
Well, banks are carrying credit on the balance sheets of books. The FASB, that's the Financial Accounting Standard Board, had a change 3 years ago that banks were supposed to, mark their assets to market. They've got housing loans where people are in default. They're carrying these things on the balance sheets as full balance at book value, as if these things are going to be paid back. Well, we know that they're not. Citigroup alone, in SIV, structured investment vehicles, had $1 trillion worth of off-balance sheet stuff. They didn't keep it on their books. It was off-balance sheet stuff. The regulators went in there and they looked at that. That's when they damn near came close to shutting Citigroup down. They went in there. Citigroup had to diversify itself. It's still not marked that stuff to market. It's called, there's level 1, level 2, and level 3 assets. So a level 1 asset is one in which you know that there's an immediate price. You bought Cisco yesterday at $22. Today, it's worth $19 or $20, wherever it closed today. You have an actual price on that. But some things are a little bit fuzzy, like houses. What is your house worth? And then there's some things that are even more fuzzy than that. And, what the Fed did and the Financial Accounting Board said, well, we're going to give you a little bit of time here. We're not going to make you mark that stuff to market. So all of this stuff, trillions of dollars are sitting out there on the balance sheets of banks, not marked to market. It's a massive game that the Fed and the Accounting Board is playing, always in attempt to bide time. You know what? It worked for a while. Is it going to work forever? Is $40 trillion worth of debt going to be paid back? I don't think it is. I don't think it's going to be paid back in Ireland. I don't think it's going to be paid back in Greece. But things don't get to where they're going in a straight line.
Yeah, Mish, I've followed your blog at globaleconomicanalysis.blogspot.com for several years now. And I was wondering if, for our listeners, you could just comment again on the whole inflation and deflation subjects, on what your thoughts are. And obviously you've written quite a bit about what we've seen in Ireland, and also what is going on in Europe with their sovereign debt. But how about here at home with our U.S. sovereign debt? Where do you see the T-bond yields going? Recently they've been kind of inching up. And what do you think that effect will be on inflation?
I don't know if it's actually inching up. They've been soaring up. Fortunately, we got out of our Treasury positions in October at a very good time, mind you. But this is the thing. I mean, just look at the arrogance of, Bernanke, who yesterday, he keeps singing the same song. And, Ron Paul doesn't buy it, and I don't buy it either. The Fed's going to be able to, step up to the plate and, shrink their assets, when they need to. And everything's going to be all really nice and fluffy, and they will recognize inflation when they see it. But the funny thing about all of this stuff is Bernanke chastises Congress. I had this quote out there. He was, warning, that the market was going to take matters into their own hands, and then he turns right around and says, well, you know what, the time to do that's not now.
Right.
So, he doesn't want Congress to act now. He doesn't want the Fed to act now. So, the sky doesn't have any credibility yet. I mean, people look at them and they say, "Oh my gosh, well, the financial assets are back, up, and Wall Street's happy." All we've done is once again bail out the banks at the expense of taxpayers. So, when does this all matter? I don't know. I keep wondering, when does it all matter? But it's important for people to realize that this is not just the United States. People in the United States are too U.S.-centric. They look at all of our problems. They only see our problems. They don't see any problems anywhere else in the rest of the world. Arguably, the banks in Europe are in at least as bad a shape as the United States. Credit in China is expanding at 35% a year. Think about that. Their GDP is going up 10%. We look at that and my God, look at that. I'd love to have that GDP. Well, credit is expanding 3 times as much as that. What does that tell you? It tells you that there's huge malinvestment going on in China. They're building entire cities that no one lives at. And people say, my God, look at commodity prices. Commodity prices are going to the roof. Someone emailed me today calling me a jerk and a whole bunch of other names. So, Mish, you're an idiot. Look at these commodity prices. This proves you're wrong, on your deflation theory. Well, my deflation theory is about credit and the value of that credit. It's not about prices. And certainly the one reason why commodities are soaring is because there is massive inflation. Where? In China. There's massive inflation in China. And, they're building all these roads and bridges and homes. That takes concrete, that takes steel, that takes copper for the water. They've got entire cities where no one is living in. And China, thinks it can keep expanding at 10% a year in a global economy where there's peak oil constraints. Yes, that's going to cause these commodity prices to rise. But look at it from the point of view of the U.S. buyer. Except for food and energy, of course. Bernanke wants to throw those things out as if they don't matter. When it's a couple of the things that matters most, right? But otherwise, prices aren't rising that much. at least right. There's no pass-through. Corporations, especially small businesses in the United States, they're getting crucified by this because, their input prices are going up, the raw commodity prices, but they cannot pass those prices on. Places where things are inelastic, food and gasoline, you've got to fill up your gas tank. When crude futures go up, boom, immediately up at the pump. But, look at the price of let's say, cattle futures, going up, sugar futures going up. Well, I don't know much about sugar because I don't buy that much, but I do buy meat, and I look at pork futures and meat futures, beef cattle futures going up and up and up. I go in the grocery store. I don't see any pass-through on prices. I buy my stuff on sale. I buy center-cut pork chops on sale, and I generally pay around $2.29 to $2.49 a pound. Not on sale. They might be $5 a pound. Buy this stuff on sale. The sale prices have not changed for 5 or 6 years. So I don't see, personally, and I do all the shopping for our household, I don't see the inflation that other people do. I don't buy milk. I don't buy, a lot of fresh vegetables. Maybe that stuff has gone up. I'm just giving you, one kind of example. But
so then is it fair to say that what you're proposing is that we're looking at a short-term deflation, perhaps even another market crash, which is usually what accompanies such a deflation? Is that what you're aiming at?
I'm saying that there's going to be another scare, that people are going to realize, once again, the economy, the Fed turns off their stimulus, and look what happened. I mean, they started to do that in, I think it was May of last year, and the stock market immediately slumped, I think about 15% or something, and then they immediately launched this QE3 thing. So, or started talking about it. Now, it didn't actually go into effect until something like November 4th, but, just on the announcement, they, stabilized the market. Now, how long can they keep that stimulus up? And how long can Congress keep throwing money at? How long can they? They can forever, actually. But how long will they? We've got a completely different Congress here than, what we saw a couple of years ago. And we're still running these massive deficits, that the Fed is monetizing, whether they, Bernanke came out and said we're not monetizing the debt. I mean, what a bunch of crap. Of course they're monetizing the debt. So there's a lot of things I agree with, with the Austrian philosophy here. It's the important point, though, is that credit dwarfs money supply. This credit won't be paid back, and when it's defaulted on, when we have more bankruptcies, when we have more foreclosures, by my definition, that's deflation. You don't like my definition? Well, my definition happens to model the stock market and the economy better than other definitions. That doesn't mean you have to use it, but it was on the basis of this credit contraction, credit deflation, that I predicted that interest rates on the yield curve would fall to all-time record lows across the entire yield curve, and I mentioned that on my blog at a time when crude was 140, and people looked at me like I was absolutely insane. Mish, you are off your frickin' rocker here. You think we're going to see record lows in Treasury yields? It happened, and then it happened again last October. Except we saw a little bit of a twist. The 5-year and the 3-year and the 2-year made new all-time record lows. The 10-year didn't, and the 30-year wasn't even close. That was a signal to me that, things are about ready to change here. And sure enough, we've got a lot of upward pressure now at the high end of the curve, because the Fed is holding interest rates negative now. So, what would one expect to see in that? One would expect to see all the problems that happened before. We're seeing leveraged buyouts. We're seeing covenant-light bonds, where where debtors are able to pay back the bondholders not with actual money, but with more debt. I mean, good grief, we're making all the same mistakes again. Bernanke reignited the junk bond market. Investors are plowing into junk bonds as if, there's no problems ahead. Well, there's problems ahead. It's going to matter. I think we're going to see another round of deflation. The Fed will probably, step back in with another round of what's doing. Very similar to what Japan did. If someone's asking me, do I think, prices of general goods and services are going to crash? No, they didn't crash in Japan either. It's just, drifted down, a couple percent a year, maybe, sometimes not even that. But look at what Japan, the precarious situation Japan is in. Debt 200% of GDP. No way to pay that back. An aging demographic now, the oldest in the G20. And if interest rates rise to a mere 3% in Japan, interest on the national debt will consume literally all of their revenues coming in, all of their tax revenues.
I think your description of what is happening with credit levels is accurate. I would describe them as the debt levels, but it really amounts to the same thing. Mm-hmm. And I think the description is accurate. I think that it is set up for what might be considered a deflationary fall. But the one thing that we do know that came out of 2008 and the months following that is that the Fed is determined under Bernanke to counter any kind of deflation with monetary inflation. It's a given, and it's become pretty clear that that's what their policy is, even though he continues to deny to this day that they're monetizing anything. Mm-hmm. We both know, of course, he's monetizing up the yin-yang. And that's the only way that you can actually have bailed out the banks to the relatively small degree he did compared to the overall debt pile that we're dealing with. So I don't really see why there's any reason to believe that once the overall debt pile starts to really crash as huge amounts of defaults happen, that they simply won't monetize it some more.
Well, monetize what? I mean, we're looking at $40 trillion worth of credit, or whatever, 35. I forget the exact number here. Is he going to do that? And also,
well, he's going to monetize off of his own business sheet. He's not necessarily going to monetize off of buying government debt, but he's certainly going to just create the money out of thin air on his own sheet so he can plug it into the bank. That's how he filled the cracks last time. That's how he's going to do it again.
Well, he's attempting to fill the cracks on the banks, and to a certain extent he did that. But a lot of this stuff is we're talking about consumer debt that can't be paid back. Bernanke stepped in to defend the banks, but he's not done anything for consumers or businesses, and he can't. He will only defend not really the banks, but the large banks.
That's right.
We're still seeing every Friday, 3 or 4 every Friday, like clockwork. Now, these smaller, banks go under. He's not doing, anything for them. Yeah, he's stepped into this. He's got a steep yield curve. So, bank profits are up as long as you ignore this not mark-to-market stuff. So he's attempting to buy time, which is, what they always do. But, he can't
only buying time. You don't see it as something that he's going to carry on as a consistent policy.
Oh, he might. He very well might. The question is, will it overpower homeowners defaulting, not paying back on their credit cards, more foreclosures, more corporate bankruptcies? I don't know. I don't think
he's not going to bail out the consumer. There's no doubt about that. But what we're really describing here is what they had in 1979, stagflation, where you have inflation taking off and you have the economy going into recession. That's pretty much what we're describing.
Well, can I ask you a question? Stagflation light, maybe. Remember, we were talking about interest rates that hit 17, 18% short term and 14% or something, on the 10 and 30 year bonds. Good grief. What happens to interest on the national debt if we even approach that? And
Can I ask you a question? Are you basically saying, if I'm understanding this, that you're saying monetary inflation doesn't necessarily equal credit inflation?
Oh, absolutely. That's absolutely true statement. Sure.
Okay.
And I'm not denying there's monetary inflation. What I'm saying is it's a mistake to only look at monetary inflation. You know, the people who only looked at monetary inflation really missed the boat. Peter Schiff is one. Gary North is another one. You know, these people looked at these things, and actually a lot of Austrians viewed things that way, and they said, my God, the U.S. dollar is going to collapse. We're going to have hyperinflation, blah blah blah. Well, it didn't pan out that way, and we're closer to hyperinflation now than we were then. Japan, for reasons that I just said, is probably far more at risk of hyperinflation in the United States. All it takes in Japan to set off a real currency crisis is for Japanese imports to shrink, interest rates to rise. They can't meet their financial debt, and if they start printing like the U.S. does, what's their currency going to do? So
if I can interject here, is it fair to say that you would reject, for instance, the claims of somebody like ShadowStats.com, John Williams, who says that despite the fact that the CPI claims an inflation rate of roughly 1% to 2% over the last 5 or 10 years, the true inflation rate's been in the range of 8 to 10%. You would reject that interpretation?
I would reject numerous things that he says. To an extent, inflation for a period, even by John Williams' stats, was actually understated. I think in the period of 2002 to 2005, when housing was going up at a phenomenal rate, I think inflation was massively understated. I think it's overstated now because I think home prices belong in the CPI. It was the Fed's biggest mistake to ignore home prices. They've got owner's equivalent rent in the CPI, but they don't have home prices directly. So the Fed missed this big price escalation, and one of the things they missed on the way back down when home prices started falling, they missed the implications of that. Bernanke missed it, and Greenspan missed it in both directions. Then home prices, kind of stabilized. They actually started going back up, along with financial assets but now home prices are going down again. So if we put actual home prices in the CPI, we would probably see a CPI around zero right now.
Well,
I think that's an accurate way to do it. So yes, I think John Williams is way wrong on shadow stats, but he's also another one of these people that only looks at things from a perspective of money. He does not look at things from a perspective of credit. And it was the crash in credit, and which caused the demand for dollars to soar. And Peter Schiff realized this, after the fact, and has talked about this. And he said, "Well, who could have seen this coming?" And I said, "Well, I could have seen this coming because I called for it." And the same thing will likely happen again if credit mark to market starts heading back down again. There will be demand for dollars that'll support the U.S. dollar. And then the other thing, I do want to get back to this global thesis, because all these people are have this, my God, look at all these unfunded liabilities, blah blah blah. The United States, look at all of this. We're going to inflate our way out of it. Actually, I believe it's mathematically impossible to do that, but they only look at the United States. They don't look at Japan. They don't look at money supply, which is absolutely soaring, and credit is soaring even more in China. They don't look at the problems of the European banks. Great Britain is a basket case. So, in isolation, should the U.S. dollar collapse? Yes, but it's got to collapse relative to something. Is Great Britain better off? Is China better off? Is Europe better off?
Right.
I don't think so. So where's the collapse going to come from? Gold, maybe. So yes, all of these countries are printing. To relative degrees. China's printing, more than anyone actually on a GDP relative basis. The amount of credit that's expanding there. We've got a huge property bubble in Australia that's going to pop, a huge property bubble in China, the UK, and Canada that are going to pop. So people in the U.S. don't even see those, don't even talk about those. They just say, my God, Bernanke's printing. It's the end of the world. Hyperinflation's coming.
Well, Mish, unfortunately, we're at the end of our time for this particular segment.
Oh, my God, already?
It's amazing how quickly it goes by. But we want to thank you so much for joining us. And before we lose you, what's your favorite blogging spot so people can check you out on the web?
Well, the easiest way to find me is just do a Google search for Mish, M-I-S-H. My blog is globaleconomicanalysis.blogspot.com. Very hard to remember, but just do a Google search for Mish. It'll take you straight to my blog. We agree on a lot of points. We disagree on some others. It's too bad we didn't have a chance to talk a little bit more about gold, but I'm not just a deflationist, but in relationship to credit, and I do like gold, and so check out my blog, and hope to be back soon.
All right, well, thanks for joining us today, Mish. We really appreciate it.